Good morning, everyone, and welcome to this morning, the last day of our Nobel symposium. Stockholm School of Economics is pretty old and runs by the old school style. And I think you have you should start a quarter late all the time, right? But we don't do that today. So we start sharp. And the purpose of today's morning is to have two panels. They're going to make like a critical assessment of research in macroeconomics, finance, and banking with insight of the financial crisis. And as we all know, many people inside and outside of academia have been pretty critical of our branches of research. And according to some, it's a big failure that we didn't manage to prevent the financial crisis, or at least unanimously warn that it was coming. So that's going to be discussed. That is going to be the purpose of these two panels. The first panel is going to focus on the responsibility of macroeconomics. So what did macroeconomics know? What should we have known before the financial crisis? Had we missed to incorporate important elements in our models, and in particular elements from financial economics and banking into the macroeconomics? How much of a lesson has the financial crisis taught us? Or is it the case that we still have lots of stuff that we need to incorporate into the macroeconomic models? To discuss these issues, we have four panelists, two from finance, who I think are going to be like prosecutors here, or I'm pretty sure about that actually. And we're going to have two macroeconomists. Whether they are going to be kind of defensive or not, we'll see. In any case, the four panelists are very prominent, and we are very much looking forward to hear what they have to say. So the first panelist is going to be Annette Vissing-Jørgensen. Annette, I think it should be pronounced. She's a professor of finance and management at the Haas School of Business, University of California at Berkeley. She graduated from MIT with actually the same advisors as me, but it seems like you managed to squeeze a little bit more out of them than I did. You have a long list of papers dealing with broad areas of issues in finance and management, how households make their decisions, for example. And in recent work, you have also helped chartering the uncharted waters that central banks have gone into during the financial crisis in using new kinds of instruments like QE and other things. And you have also looked at how information is transmitted from the central banks to the market in formal, but also in informal ways. The second person who's going to be on the prosecutor side is Luigi Zingales, professor of entrepreneurship and finance at the University of Chicago Booth School of Business. And you deal with finance in the broadest sense of the word. Are financial markets good for growth? Are culture and religion important for economic outcomes? And you also have been very active in the popular discussion about economics, finance, and politics with regularly appearing op-eds in the world's most important newspapers. Perhaps in the broader circle, you are most known for your book together with Raghu with the title Saving Capitalism from the Capitalists. And a paper title of yours that I like, I guess, capture the idea pretty well. It says, the survival of the fittest or the fattest. And I think that's a theme in that book. So on the defense side, we have Nancy Stokey. She's professor of economics at the University Chicago. I have kind of notes here, and there was something missing, and I didn't want to make a mistake. So, and she, of course, is one of the leading researchers on macroeconomic and growth, and everyone, I guess, who have taken macroeconomic courses at the PhD level have learned a lot of their trade using the great textbook Recursive Methods in Economic Dynamics, written by her and Robert Lucas. And with him, she's also been one of the front runners in analyzing time consistency problems in monetary economics and the interaction between fiscal and monetary policy. And you've continued to do research along those lines, policy and fiscal policy and monetary policy and growth. And you are also a member of the US think tank, the Copenhagen Consensus, with the aim of trying to find solutions that actually work to the great problems of development, aid and poverty and malnutrition and diseases. The fourth panel member has also made fundamental contributions to the problem of central banking. Robert Barro, professor of economics at Harvard, is among the world's a handful of the world's most influential macroeconomics of all times. The Barro-Gordon model that shows the value of committing monetary policy to rules has really, rules like the inflation target has really changed the world. The strong and clear policy implications of his work on optimal taxes, that taxes should be smooth even if the expenses of government is changing over time, is clearly a centerpiece in all finance ministries over the world. And you work on conditional convergence of GDP per capita between regions and countries is taught to everyone at all levels in macroeconomics. So it's really great to have you here. So let's hear what you have to say and let the discussion start. So Annette is the first speaker.
Thank you very much for having me. I came from California, so I thought I'd frame our discussion by drawing some parallels between fighting financial crisis and emergency management. And so if you read the FEMA manuals on how to do emergency management, there are the 4 steps that I have listed there. Let me talk about them one at a time. First, you have to do good risk assessment. And I think it's fair to say that before the crisis, a lot of us were worried about high household debt. My most fond memories of Elizabeth Warren, actually, who may be the next US president, was at the first Household Finance Conference at HBS back in 2006 and showed default rate by cohort for subprime mortgages before anyone else had appreciated it. Even I, who's actually not a very foresighted person, did a focus lesson in the summer of 2007 at the CEPR, laying out facts about how household debt had gone up, discussing securitization, calling for more work on the drivers of increased household debt, and perhaps some policy responses to a lot of debt. So I think the question is, why was not more done in order to slow the boom down? And here's my story. So inflation was low, so the Fed hawks had little argument that more should be done to raise rates. Volatility was low, VIX was low, we were all talking about the great moderation at conferences. And following Bennington and Girdlers-Jackson whole paper, the conventional wisdom was that one should not try to pop financial bubbles, that the appropriate way to react to this was to follow inflation and growth carefully and react to it only as it showed up through those variables. And I think, let's see if we can get to a Stockholm consensus. I think one of the themes of this conference that a lot of people actually have brought up over the weekend is that our beliefs, the way we model beliefs in macro, the way they model beliefs in macro, of using rational expectations, missed the fact that a lot of people had and have extrapolated expectations. Consumers thought house prices would keep going forever, and we thought the great moderation would keep going forever. And I wanted just to remind you, or to give you a little evidence. I think in my mind, one of the simplest way to see that there's something wrong with beliefs is to look at the beliefs of different people at the same time, because then they should all have the same expectation about a given variable. So these are some old pictures of mine from a macroannual paper from back in 2003 that shows the differences in beliefs between the young and the old. And to the left is the expected stock market return, to the right is expected inflation. And you can see that after there has been a run-up in either realized stock return or in realized inflation, the young have much higher expectations than the old, consistent with essentially people doing Bayesian updating based on the data that they themselves have lived through. This has a lot of the flavors of what Andre was talking about in his paper yesterday. Finally, I think there was a lack of appreciation of resilience to shocks. So Barro, of course, famously argued that there was all kinds of risk building up in the financial sector, but I think a lot of us had missed the fact that high leverage, tranching of MBS, complex intermediation chains were things that ex post made us very unresilient once the shock hit. So a lot of the macro, I would say most of the macro models missed this because there was no modeling of banking. It was more households, firms, governments, somehow banks, when the intermediaries were just not in there. So since the crisis, of course, a lot of the post-crisis policy has been about building resilience. And I listed there sort of a laundry list of things that have been done. We haven't been tested yet, but a lot certainly has been done. I think I'm glad to be on the panel with Barro because I think, oh, sorry, not with Barro. I would have been even happier, no. I'm glad to be on the panel with Luigi because I think he has been sort of one of the main people arguing that competitive markets do not lead to resilient outcomes. And also something Barro touched about on yesterday, that the more competitive the market is, the more you get sort of people competing in relative performance. And I'd be curious to hear what the sort of more firm believers in market outcomes have to say about this. In terms of the response, Ben touched upon or showed convincingly, I think, that a lot of the response was about stopping panics. And one thing that I have learned, both in terms of QE's effect and in terms of monetary policy in general, is that a lot of it works through movements in risk premium. We had in our discussion of DSG models some discussion about risk premium shocks. And I think one of the main things that monetary policy has and can do is to lower risk premium. In the QE, in the context of prepayment risk and corporate default risk, but also if you look at the just regular monetary policy from day to day. So let me just show you one picture. This is to the left, the realized stock return over what we call the FOMC cycle, so in between meetings. So take my word that the monetary policy news comes out in even weeks, so around days 0, 10, 20, and 30, and see how high the realized stock market returns have been. These are 5-day buy and hold returns. To the right is, based on Ian Martin's data, movements in equity risk premium over the cycle. And so what happens is the equity risk premium goes down as a result of Fed policy. The stock market, therefore, shows high realized returns. So standard macro models focus a lot about how monetary policy works through the expectation hypothesis. I think we need to have sort of a paradigm shift to say, we need more finance guys helping us out with this because a lot of this works through risk premium. Also, since Ben brought this up, this whole idea of fighting panics actually has a natural relation to the Fed put, which says that the Fed eases aggressively following very bad shocks. And there's evidence that when the stock market tanks, essentially, the Fed aggressively has lowered the target or done some of these more unconventional things. In terms of the recovery, I'm thinking I'm out of time, so I'm going to say okay. In terms of the recovery, first, we should give policymakers due credit for having gotten us out of a very bad situation, but in terms of what keeps me awake at night, policy has been extremely lax, which must mean that the true fundamentals are a lot worse than we think. I am also personally worried that this sort of Fed put saving us whenever bad things happen has made volatility look artificially low. And so the true underlying risk is worse than we think and could sort of pop up at any moment, especially because this Fed put, the more people appreciate it, the more there's an incentive, the more moral hazard problems we get, since people will layer on risk thinking that if something bad happens, the Fed will be there, the ECB will be there to save us. Finally, I'm worried about the high US debt to GDP. I've spent a decade writing that treasuries are special. I'm a little concerned that they may not be as special going forward. We have an unprecedented high deficit given the state of the business cycle. Debt to GDP is, currently 80 going on 100. And I personally worry we could have a rollover crisis if we have a recession and things get even worse. And then I wanted to give due credit to the Bank of England, actually, for being ahead on my fourth worry, which is some sort of cyber attack on the financial sector. Supposedly, the Bank of England actually monitors which financial systems all the institutions are using to try to prevent some kind of coordinated problem. What do you think would happen if all Chase credit cards that have already been hacked had 10 frauds on them on the same day? The whole payment system would freeze up. Everyone would run to get cash. There would be a run on the banks. And are we ready? We'll see. Thank you.
Thank you very much, Annette. Luigi?
So first of all, let me start by thank you, the committee, for the invitation to speak in front of such a distinguished audience. I don't feel I deserve, because I'm a silly finance guy, not a macroeconomist, even if, true to be told, I study money and banking at MIT. And in fact, I think that I'm the only one of my generation and older who studied money and banking who has not become a central banker, probably because I miss Stan Fisher. He was visiting at the World Bank, but in exchange I got actually Ben Bernanke, who was visiting at MIT in 1990, who taught me actually bank run and made me interested in finance. So I'm very thankful for that. I am in the uncomfortable position of being the prosecutor, so I try to make some claims, and as all the claims of the prosecutor, they're not necessarily all true, but I think that to get the discussion going, I think I would like to make them at least sharp, and then we'll see whether they withhold the defense. So the first one, and is if we look at least at the macro textbook, I think the role of finance, and even more the role of financial stability, has been ignored in the financial literature till the financial crisis. And I actually spent some time looking at the textbook from the early 90s to today, and the only mention of banks is the financial multiplier, the money multiplier. There are some mention, but very little, of financial friction. The only reference to financial fragility is the story of It's a Wonderful Life, and they describe it exactly as this faraway thing in the past and very romantic. And one famous textbook has this footnote that say to stop a run, a bank had to convince customers that it was sound and had plenty of funds available. That's what Jimmy Stewart did in A Wonderful Life, and seems like not a particularly sophisticated strategy to stop a bank run. And this is only a partial set, but I tried to look at the abstract of the article published during this period. And what you see is there are lots of articles about inflation, lots of articles. A few articles about banking, where Google was right that people were falling asleep when we were talking about banking, but it was even more falling asleep if we were talking about financial crisis and lender of last resort. It was not like a very important topic until very recently. Now, the second point, and this is, in my view, even more serious, is that the role of central banking was only viewed as maintain price stability if you are in Europe, or you had full employment in the United States, but not much else. So the textbook do not mention financial crisis with the exception of the Great Depression. Now, as Carmen has reminded us yesterday or the day before, there were plenty of financial crises. Not that some people say you have to wait 50 years to see it. No, you just look outside of the United States, and there are plenty. And the interesting thing is a very good set of research came out of MIT, thanks to Ben Armstrong, just because he's Scandinavian and saw a financial crisis here. But people can actually look outside the United States and see. They don't need to live in a different country to see that there are problems. My test is to see how much Doug Diamond is cited, and basically citation 0. There are, of course, citations to Peter Diamond, a textbook, even a citation to Jared Diamond, but not to Doug Diamond. And very marginal mention to the lender of last resort. In fact, the GA yield code for financial crisis was created in 2008. It did not exist before. Now, quoting for probably the most important book in monetary policy, the book that has been quoted the most. I'm going through the Open Market Committee minutes, and the author that decided the most is actually Woodford. And Goodhart, in his review of this book, says it's a wonderful book, but basically, effectively is default-free. The system, there is no need for financial intermediaries, there are no commercial banks, there are no financial constraints, indeed, nothing related to finance at all. These are Goodhart's words, not mine. And certainly, there is no worry about financial fragility. Now, what is fascinating is that Woodford started studying chaos, sunspot equilibrium, and panic. So it's not that Woodford did not know this stuff, is in order to be accepted in the community, had to remove everything that is fragile in the community and talk about inflation. That's the way you get ahead in the macro community. And I propose this test in terms of allocation of resources. How many economists at the Fed are studying the optimal rate of inflation, and how many are studying the optimal use of the lender of last resort sort of function? And then you study the welfare losses, error in the first case, error in the second case, you adjust even for the probability, and then you see whether there is a good allocation of resources or not. And the reason why I'm so sensitive is because I am Italian, and basically the macroeconomic profession has designed a European central bank that is very similar to the Maginot Line. It's designed to fight the old war, completely incapable of dealing with the real problem today. And so the macro profession has generated a European central bank that did not even think about financial stability in any serious way. And maybe it's my ignorance. I said I'm not a macroeconomist, but really this notion of panics, even the multiplicity of equilibrium in the sovereign debt, I discovered my own expenses looking at my own country. I don't remember, and maybe this is my ignorance, I'm very open to see, but when the euro was created, when the European Central Bank was created, did anybody worry about the fact that there was a possibility that there would be some panic that is self-fulfilling, and the central bank should intervene to stem the panic? I'm not aware, but I'm hoping to be sort of proven wrong. And I'm very glad that Ben talked about panic yesterday, because my friend John talks about fluctuation in risk aversion. But I have a paper actually looking at survey data. When I did it many years ago, it was basically impossible at Chicago to look at survey, but now we even hire Harvard students who look at surveys. And what is interesting is we were able to actually ask the same question to the same people before and after the crisis. How did we do it? Because my co-author had run a survey before, and we compared the same people before and after the crisis, and this is the measure of the risk premium. And you see the mean is not very different, but the median is enormously different. And there is nothing in the standard model that can explain this difference, except some form of, if you want, uncertainty aversion. One thing that is fascinating is 1/3 of the respondents that in 2007 were able to say how the distribution of return might look like in the next few years did not answer the question in 2009. So the way I interpret it, was so uncertainty confused, if you want, that they did not even were willing to state the fact. And these fluctuations that are driven by phenomena, political, etc., they tend not to be incorporated in the model, or at least they might be integrated as a wedge we learned yesterday from Ellen. As a result of this, there is no real investigation of the difference between illiquidity and insolvency, and how to develop a state contingent rule to figure out which is which. So yesterday, when Mark Gertler presented his model, I raised the question. I said, wait a minute, in your model, in lender of last resort, we solve everything. And he correctly answered, oh no, but there is a layer of uncertainty we need to sort out. That's exactly the problem. Even his model now does not have this layer, does not tell us how to separate, let alone the model before the crisis. As a result, the consequence of this is that the response in the United States, and I don't want to enter a response in Europe because it's too close to home, especially today, but the response in the United States, and I use the word of the legendary endowment manager, David Swensen, who runs the endowment of Yale very successfully, and they say the government has done it, i.e. intervening, with an extreme degree of inconsistency. You almost have to be trying to do things in an incoherent and inconsistent way to end up with a huge range of ways that come up with to address these problems. So I think that lack of, since consistency is one of the themes that of course is very dear to to Robert and Nancy, but I think that we need consistency not only in fighting inflation, is very important. We need consistency in how to deal with the financial crisis. The way you develop this consistency is to study the phenomenon before the crisis arrives and to develop some policies. Now, how to make it credible, I will let Robert answer this question, but I think that it's very important to study more. And in the rest of the debate, I will discuss what has been done in ever since, but I don't think is enough. And I'm sorry to say the current and persistent crisis of the euro suggests that not enough has been done. Thank you.
Thank you very much, Luigi. The next speaker is Nancy from the University of Chicago.
Oh, sorry.
Okay, well, I want to start by thanking the organizers for inviting me. It's been a wonderful conference over the last 2 days. I've learned a huge amount. And let me start by apologizing to Annette and Luigi. I'm not going to address your remarks just yet. I prepared some remarks back in Chicago and trashed those during the conference and rewrote some other remarks. And I'm not quick enough to do it again on the spot, but I'll address them later. And also, I'll apologize to all the macroeconomists in the audience. You know, I'm not going to defend you. I agree with much of what Annette and Luigi said, so I'm going to pile on. Okay, so what have we learned about the financial crisis? So over the last couple of days, we've seen, I think, just a magnificent, survey of what's been done to, understand better various aspects of the crisis. And I've just put a few points up here. So the decline in liquidity, runs on banks, runs on the repo market, balance sheet constraints, and so on. The role of leverage, the importance of policy instruments, what are they, what should they do? And the similarity of episodes across many periods in history and many countries across the world. So since I just have a few minutes here, I'm going to take the last point and the first, and I want to think about just like trying to make a couple of, draw a couple of parallels between what happened in the recent financial crisis and what happened in the 1930s in the US during the Great Depression. Okay, so what do we know about the role of liquidity? We know that pretty much every financial panic involves a flight to safety. So that seems to be a fundamental element. The specifics play out differently in different times in different places. So in the 1930s, I think the monetary history by Friedman and Schwartz still provides insights that are as good as we can do. Okay, during that episode, the flight to safety meant a flight out of demand deposits and into cash. And that's because demand deposits were risky, there was no deposit insurance, and it led to bank runs. So over the period 1929 to 33, the cumulative decline in bank deposits was 48%. And then over the same period, the cumulative fall in nominal GDP was 58%, so same order of magnitude, and that was split about 60-40% between real and nominal. So at the same time bank runs occurred, many banks failed, and many households had their assets wiped out. Okay, and I think the reason Friedman and Schwartz focused on money was that at that time that was the means of payment. Both demand deposits and cash were like the primary means of payment in the system at that time. And it was a deliberate decision by the Fed to let demand deposits fall. So during the Great Recession, the Fed chose a radically different course. They pumped in a lot of liquidity. We had deposit insurance that was even extended to money market funds. So a lot of the specifics played out very differently. The resulting recession was still, kind of deep and very prolonged, but, presumably it would have been even worse without, these other measures in place. So what was the analog of the bank runs and the flight, out of demand deposits into cash during the Great Depression? I think, this is where it's a challenge to the people in finance to help me. It sounds like it's treasuries were very much involved. They're, a very safe liquid asset. And during the recent crisis, it was commercial banks, investment banks, and other financial institutions that were worried about their liquidity, their solvency. So they started hoarding treasuries. The repo market, which seems to be very important for in terms of means of payment and transactions. I guess cash managers use the repo market very extensively. The volume in that market, just dropped like a rock. I mean, probably half the people in this room know that data much better than I do. But right after the collapse of Lehman, it plunged. So Gary Gorton talked about the run on the repo. Okay, so what is this run to safety, and why do bank runs occur? Why did the run on the repo occur? Well, I think Diamond and Dybvig's model of bank runs still gives us a valuable lesson on this one. Some parts of the financial system they're very fragile. So, and in essence, demand deposits, to my mind, demand deposits, money market funds, and the repo market, demand deposits and money market funds, they basically involve a grain of fraud. And that's the promise that anybody can withdraw all of their money at par at any time. Literally, that's just not true. So the deposit insurance has made us comfortable that for demand deposits, there's backing. That's why there was a decision to extend that to money market funds. In the repo market, the promise is not explicit, but I think the strong expectation is there in every player in the market that if you can keep rolling over, and that's the part that during the crisis that wasn't true, and it was the kind of the failure of that seems perhaps was important. Okay, so what's missing? This is where I agree with my colleagues in finance that, first of all, what we're missing is just, to my mind, a clear, simple model of what are the common elements across all these financial crises. We have dozens, if not hundreds, of examples. And I think what we're lacking is kind of a clear, very simple framework. And by this, I mean just a very stripped down framework. Think of the real business cycle model as a template. Something simple that's very transparent and capable of elaboration in a variety of directions to study more specific things and to do empirical work of various types. But we don't have that. And as Annette and Luigi pointed out, lots of macro models don't have any financial markets at all. Well, that's okay. Maybe we don't need them to study every macro question. But liquidity, a little bit more since the crisis. We have models with at least some banks, but we don't really have a very rich financial sector. There's I don't know of any with where liquidity is modeled in any with any sophistication. So so we have these real models that don't have much of a financial side. On the other hand, people in finance look at a wide range of assets. They look at rates of return, spreads and volumes, but they very rarely make any connection with real activity. So I feel like the macro profession comes this far, but doesn't really have much of a financial side. Finance comes this far, but doesn't make the bridge to real activity, and there's a little space in between there. And financial crises all fall into that little space. So we're in that space, we're just like in the abyss. We don't understand a lot about what's going on. And so I think, it's, we need better models.
Thank you very much, Nancy. Robert?
So, as with Nancy, I guess standard macro models are in trouble if I'm supposed to be a chief defender. But I wanted particularly to say some things about basically the history of sticky prices as a part of standard macroeconomic models of business cycles, including recent ones. So first I would go back to the early 1970s, and a major model there with sticky prices is the disequilibrium framework, which I perhaps contributed to with work with Herschel Grossman. This model featured sustained excess supply of both goods and labor, with the idea that both nominal prices and wages were sticky and were also too high, so that you had sustained excess supply. And the quantities were determined on the short side of the two markets by demand. And that gave a kind of sensible version of the Keynesian demand multiplier. But associated with that particular case, there was an analogous model on the opposite side with sustained excess demand when prices and wages were too low. And there was a supply multiplier that paralleled the demand multiplier, which is more familiar. This model had a period of a boom where it was tremendously popular for a relatively brief period in the early 1970s. I suppose I contributed to the demise of that model by kind of disowning it at the time. And I think the critical matter there was a lack of a good theory about price stickiness and what it really represented, both sticky prices and sticky wages. So I think that was the thing that kind of upset the popularity of those frameworks. So later in the 1970s, there was flexible price kind of equilibrium models of money and business cycles. This featured some kind of incomplete information, and the focus there was particularly about the general price level or monetary aggregates, that those things were not fully known and understood contemporaneously. That produced a framework where monetary shocks would have real effects, particularly on output, basically because of a confusion between the general price level and relative prices. There were important implications for monetary policy that came out of this framework, particularly the idea that only unanticipated monetary shocks would matter, so there was a kind of short-run effect of money on output, but certainly not longer-term effects. There's a sense, I think, in which this is the high point of theory related to money and business cycles, certainly in terms of the quality of the underlying theory. I think these models kind of moved out of favor, particularly because the informational problems that were highlighted ultimately were thought not to be all that important. And in particular, it really wasn't very difficult to know something about what was going on with the general price level and monetary aggregates. So the informational gap that was highlighted perhaps was not first order. So more recently, and particularly since the time of the financial crisis, this field is dominated by so-called new Keynesian models, which are, I think, used pretty much by all central banks in terms of actually thinking about the formulation of monetary policy. So implicitly, these models focus on the sustained excess supply case that was featured in the disequilibrium models back in the early 1970s. So as in those models, these frameworks feature something that looks like a Keynesian multiplier kind of effect associated with prices being fixed at a too high a level. So kind of that's what underlies excess supply. Somewhat surprisingly, the usual emphasis in these models is on the goods market, and in most of these models, the labor market is secondary, and often the labor market is assumed to clear, which is quite surprising if one thinks about the Keynesian framework going back much earlier in time. I think one advance in these models is the element of some kind of monopoly on the supply side in terms of sellers of goods and services who are also thought to have some kind of monopoly power. So that produces some kind of markups where price is bigger than marginal cost. And that means that there's a good reason why sellers would meet the demand over a certain range. Because at a given price, it'll be profitable to meet the demand when it goes up and down, at least over, unless there's a really big shift in demand. So that's an advance over the earlier models that didn't feature this kind of element of monopoly. Now, of course, it's not obvious why monopoly is always on the selling side, and it could be the opposite, particularly if you think about demand for labor. You can think of a monopsony model where you would think the monopoly power would be on the other side, and that'll basically produce a framework with all the opposite kind of relationships as what the usual one. But as I mentioned, typically in the labor market, sticky wages is not a central element in the recent models. Now, an earlier idea about why wages were sticky was about long-term contracts, and that wages were only adjusted infrequently associated with the duration of contracts. I think that idea is not featured so much now because I think people were a lot convinced that sticky wages in that context need not have much of an allocative implication. So if you think of a contract where you set the wage over a year, but basically part of that contract is that a person works more when there's more work to do and works less in periods that are more like slack. And you don't really need to adjust the wage all the time in order to get some approximation to efficient quantity responses. So in that context, that's an example where something that looks like a sticky wage may not actually matter, and it's as if the market were clearing. But a more striking feature of the new Keynesian models more generally, of course, it's not clear where the sticky prices come from. And Mark Gertler made a remark to me recently. He said the real surprising thing about this is that people basically tend to assume sticky prices without apology or embarrassment in these models. It's just kind of there, and it's that nobody really worries about it anymore. And that's been true for some time in this period where these new Keynesian models have become kind of dominant in this area. So more specifically, as was discussed yesterday, you often have this Calvo pricing with respect to how the sticky prices are modeled. This comes from Guillermo's 1983 paper. So one important thing I learned from Guillermo a couple days ago was that I apparently played some role in rejecting this paper at the JPE when I have zero memory of this, and I'm really kind of suspicious about it. I need to see whether there are any records about this. Because this is quite embarrassing. I mean, regardless of what I think about the quality of this model, it has 2,100 sites, real sites in the Social Science Citation Index, which puts it way out in the tail in terms of citations. So that's a little embarrassing. Anyway, the Calvo model is very tractable in terms of assuming that prices only adjust and kind of at random intervals that are exogenously determined. But it produces some strange results because it produces these fat tails of these errors with respect to prices being incorrect, and it also has correspondingly large price adjustments in a substantial fraction of the sample when they do occur. And this doesn't seem to be empirically realistic. So alternative sticky price models have some kind of feedback where they're more likely to occur when the prices are more out of whack with where they should be. And I think that that's a better model if you're thinking about this kind of sticky price framework. But the basic idea is more fundamental than thinking about differences between Calvo pricing and menu cost models of pricing. Because really the key element, a centerpiece of the new Keynesian models, is you have these price stickiness rules that are treated as invariant relationships, as though they came from some very basic idea, Whereas in fact, you would expect them to change character if there was a shift, for example, in the nature of monetary policy. And more generally, as I discussed previously with respect to labor contracts, there's a question about whether prices being observed not to move very frequently has important allocative implications or not. But if you don't think about what the price stickiness represents, again, a centerpiece of these models, you really don't know how to think about those questions. So in the end, I come back to the question whether the kinds of models that are used particularly by central banks, this new Keynesian framework, whether this really represents technological progress over the disequilibrium models that were used particularly in the early 1970s. And again, I think those models dropped out of favor because they didn't really have good underpinnings with respect to what sticky prices and wages represented. Well, I don't think the new models have made any progress on that front whatsoever. And in terms of thinking about the interplay between goods and labor markets, I would say the current form of models, which has been around for quite a while now, I think it's obviously inferior to the models that were there previously. So somebody argued to me yesterday that this is a good moment for me to re-embrace the work that I did in the early 1970s, and I'm not sure whether that's the best course, but on the other hand, I probably like those models better than the ones that are so popular these days. So I'm also happy to interact, particularly with Luigi, on the interplay between finance and macro, but I'll stop right now.
Okay, thank you very much. So it seems like a crime has been committed. We came into the financial crisis with macroeconomic models that didn't really do what we wanted them to do, and you have pointed to many things here. So I would like to hear what you think about what's the reason for this. Why didn't we have it in? Luigi pointed to one thing, namely that it's kind of US centrist research, and US had a long time without financial crisis. But as Nancy said, we have had lots of financial crises over time around the world, so they could have been there. Another thing that's often heard is that one of the problem is that macroeconomists have had like an almost religious belief in rational expectations, and I think Luigi, you pointed a little bit to that, and it's one way of phrasing what you said is that we have rational expectations among our agents, but the macroeconomic theorists are backward-looking, only fighting the previous fights. So the issue is, do you think that are these the reasons, or are there some other reasons, and does it have to be like that, or could we expect that we are more forward-looking in the future? Anyone?
Actually, I would like to elaborate on one and add another. So elaborate on the fact of the sociology of the profession, which is not just for macroeconomics, is for every subgroup of our profession. We tend to focus too much on what is in vogue in that moment. So the reason why now everybody is resurrecting those models is because we just had a crisis. We think there is a sort of a deflationary period. We're trying to explain reality, so everybody is studying on this. And maybe there is an overinvestment on this. We had 70 years of relative stability in the United States. Nobody thought about this. And we thought that the only problems were the business cycle are created by fluctuation in interest rates at the Fed to try to fight inflation. That was the focus because the United States, that was the problem. I think that the problem actually has gotten worse with more and more people looking at the United States as the only place. You go around the world and you find very good researchers. They all try to actually publish in US journals, and in order to publish in US journals, you're better off doing what everybody does in the United States. So I went and did a review of the finance department, just to say, of Bocconi, and I discovered in the middle of the largest banking crisis in Italy, everybody was studying the United States. And I said, wait, that doesn't make any freaking sense. You go to China and they study the United States. And why? Is because the academic market is somewhat distorted in that direction. And so I don't know what to do, but I think as academics, we need to think about this. And maybe the Nobel Prize Committee should reward people who have been outlier for a long period of time and have done stuff, because that's a way to reward long-term bet. I think that's very important. The other thing is a segmentation between business school and economic department. I think finance was something that was done in business school, like marketing. And so there was less of an integration. I think that why the Olmsted-Tirol model is so famous, because at MIT, the Sloan School is particularly well integrated with the economic department. And so you had people like Arvin and like Guido studying with banked that has two advantages. One was in the business school, and two was has seen a financial crisis. And that has created a little cottage industry of people doing that stuff. So I think we need to be a bit more integrated. That's my view.
Robert?
I think over the last 10 years or more, there's been tremendous development in terms of interplay between macro monetary models and finance. Mm-hmm. There's a tremendous amount of research going on about that. Some about financial institutions, some of it is about disaster risk, some of it is about macro disasters. Certainly in terms of the empirical work that I've done in that area, it's very international oriented, it's very long-term oriented. It's very clear that the Great Depression is just one of many financial crisis events, although that was kind of a global event, which makes it unusual. The biggest two macro disaster events other than that in the history are actually the two world wars. But people don't usually focus on that because they tend to think about more business fluctuations type of areas. But there's been a tremendous amount of work on the interplay between macro and finance, and journals are extremely receptive to that. I don't know why you think that there's an idea.
Now, recently, yes, because something hit the United States. I'm just saying that if we want to be more open to what is next, which we don't know what it's going to be, okay? I don't have the magic wand and figure out what it is, but I'm saying being more open and interplay, and maybe the next crisis is in some cyber risk, and we need to talk more with the people in the computer department. Who knows? But I think that we tend to be, and I think finance as well, very provincial and very close because we operate in small groups. And I think that is not that easy. Now, after the crisis, of course, there is a lot of interplay between finance and macro, but there is not enough interplay, for example, with marketing and or the consumer. I think that we need to be more broad. That's my only thing. And this is not a criticism of macro, it's a criticism of economics in general.
Nancy?
Yeah, I'll say I think that we should remember that we're supposed to be social scientists. So we should not be just studying individual episodes, but we're supposed to be thinking about economics as a science where there's some commonality across. We could go back, you would think about predicting the next crisis. Can we, if we go back and look at the old data, can we predict past crises? I would guess we can't. So we could start with that. Can we forecast the past? Maybe if we get good at that, we could try and think about forecasting the future.
Actually, Atif and Amir and Alan Taylor, etc., have shown that rise in household debts does forecast crisis pretty well. So it's not that we're so terrible at doing that.
But it seems fundamental.
That was one episode.
No, also other crises, not just this one.
I don't think that was like in 1929. Was that the...
Actually, where is Alan Taylor? I think yes, I think also 1929. But anyway.
It seems fundamental that most really big crises have to be unpredictable. And I don't think it's a great metric with respect to how well we're doing about whether we can predict crises in that sense. I think in terms of what Nancy said about being scientific, you might be able to do something that affects the probability of crises, something about the probability distribution. But I don't think it's a real test of the profession to say, whether or not we predicted what happened, for example, 2008.
No. Of course, all the crises, like all the surprise attacks, by definition, they're surprise. However, if you're in the army, you need to know how to deal with a surprise attack. okay? That by definition is by surprise, but you need to have a strategy to deal with it. And I think that the strategy that we had were made up on the fly. And at the end, they work out okay, but the question is why we're not more prepared to deal with that.
You know, that's fair enough. I think what really mattered in the reaction was the lender of last resort function, including especially bailing out something like AIG and Morgan Stanley. I think that was quite central. And I agree with you that that's not in macro models. That kind of thing is not, or particularly wasn't discussed as a centerpiece of these models.
Yeah, but the problem, and I'm the first one to be blamed, because I at the time did not understand properly the budget rule that say budget. I don't know how to pronounce the budget rule. No, not budget. The economist, central banker.
Budget. Yeah.
Budget. Okay. First, maybe you don't even know who is he. Is the rule that say that you have to lend freely under good collateral at a penalty rate. And because it's a problem of illiquidity, not insolvency. Or to the extent it's a problem of liquidity of insolvency. The problem is that most of our models find it difficult to have an illiquidity that is solvent because the connection is panic. If you have panic, then you can be illiquid and solvent. But in our economic models, panic, irrational panic or self-fulfilling panics are not really captured very well. And so you tend not to use the lender of last resort or consider everything a bailout. If you can explain the difference between a bailout and the lender of last resort function, I think that's quite important in dealing with the crisis. And I personally was unprepared at the moment of the crisis. I don't think anybody was prepared. At least if they were, I did not hear them talking at the time.
Annette?
There's a lot of confidence up here. I think there should be a little more humbleness in the profession, in the sense that we should just recognize we can't forecast all these crises. And that's why I said we should focus on creating resiliency. And I think one of the problems that macro has sort of put upon itself is to focus a lot on mean outcomes. When we think about Taylor rules, it's all about mean growth, it's all about mean inflation, and there's not as much role for uncertainty. And so, given the fact that crises are panics, which are about the left tail, I think we need many more people studying left tails, uncertainty, and then just be ready. Once the shock hit, try to be as ready as we can, rather than sitting here and apologizing for why we didn't predict the crisis. It's impossible to predict crisis well in real time. We should focus more on being ready once a crisis hit.
And it sounded like you were fairly pessimistic in the sense that I heard that you said that we're kind of, in a sense, using the old models still in dealing with the crisis, and then actually building up for the new crisis.
Yeah, I mean, if you look at these, when I first started working on QE, we did this work on, you take 10 different interest rates and try to tease out what's moving when you do QE. Then we would go around and give talk at central banks, and people would say, look, we're having a hard time getting this into our model because we have one interest rate. Like the really sophisticated ones would both have a short interest rate and a long interest rate. No one had a spread. And so in terms of being ready to study what's going on, we need to have models that have like realistic risk premia in there, so we can study, are they moving and what should we do when they're moving?
I think, Annette, you were sort of partly right and partly wrong. We can't predict crises. We can't predict exactly when they'll occur, but that doesn't mean we can't identify periods when we're at higher risk. And I think in your opening remarks, you were talking about, how, debt was piling up, and, some people had looked at the housing market and said, this seems to be getting, out of line with the rest of the economy. So I don't think anybody could have predicted the date when it was going to happen, but maybe we can predict period. We can think of ways, as professionals, we can look for, the warning signals that a crisis is more likely, and think about taking steps before it actually occurs to either, avert it altogether or at least make its effects, less severe.
Robert?
So I agree with what Annette said about bringing in certain spreads between rates of return. I mean, I would have focused on the difference between expected return on capital and some kind of safe real interest rate, which is basically saying that macro models need to essentially explain the equity premium at the same time they're doing other things. And current environment, the safe real interest rate has been very low for some time, but I don't think the expected return on capital or equity has been low. And I think that that's much more relevant in terms of thinking about implications for investment and economic activity. And I think you have to bring in something about changing disaster risk in order to interpret these patterns. Just to go back to what I was saying in my opening remarks, I mean, I was thinking about why basic macro models have problems in terms of especially explaining monetary role in business fluctuations and how that particularly related to the price stickiness forms of the modeling. But I think the reason that that's problematic is because this is a difficult problem. I mean, you're trying to explain why some nominal thing related to what monetary authorities are kind of doing all the time and real stuff. And sort of the models are trying very hard to say that those things are basically neutral. And then you try to come up with clever ways in which that's not true. And that is not easy, and maybe it's impossible. But I think the failures of the sequence of models that I was going through is related to the fact that that's a hard problem. And I don't know that I have a better way of resolving that problem currently.
So on the optimistic side, I think that we now agree, hopefully, that there is one fundamental causes of financial crisis, which is short-term debt. And we do understand now that there is excessive production of short-term debt. And so in some way, we need to think about how to deal with that. I think that to me, that's a big result of the financial crisis and the research that has sort of generated. Now, the question, we disagree how to best deal with that, but I think that that's a common thing, which is pretty important.
So you would say that also applies in the Great Depression because you're thinking about deposits as being analogous to the kind of short-term debt that you think about in the recent
absolutely.
Financial crisis.
And not to bring it to the current event, but the reason why there could be a crisis tomorrow in Italy is because people will withdraw money from the banks for fear that there will be an exit of the euro. So I think that the short-term debt is always what precipitates the financial crisis. Now, as Doug Dammer would say, there is a reason why the short-term debt accumulates leading into the financial crisis, because there starts to be a solvency problem. So it's not exactly exogenous, but I think is a very important indicator. And some fundamental research that has been done shows that there is too much production of short-term debt with respect to what is socially efficient. And so something needs to be done on this front. And this is where the world disagree. And there are people like John that want a nationalization of the banking system and have a narrow banking, doesn't call it nationalization, but narrow banking is a nationalization of the function of providing of liquidity, which is actually not a bad idea in my view, but that's one extreme. But we need to do something on that, because that really is the source of instability. And this has been obscure for many years because it was a very heavy regulation in the United States. And so the period of stability made us complacent. But the financial world is not that stable. And unless it's regulated, leads to potential tail risk. And we need to do something about it. I think that that's an important thing we don't want to ignore out of the crisis and the research that is underlying the cause of the crisis.
Annette?
I guess I would like to ask a question to my sort of more RBC counterparts here. You know, when I used to have lunch with Nancy and Bob at Chicago years ago, whenever we started talking about government intervention, Bob would say, but why? You know, what's wrong with the competitive outcome? And that was always a great starting point for a good discussion. And so I thought I would ask you guys, do you actually think that competitive economies are, you know, relatively resilient, or do you agree with Luigi's assessment that there's naturally going to be too much short-term debt? And to what extent do you actually think we should intervene? Do you think we have over-intervened relative sort of to the Chicago lunchtime benchmark of what one should do?
Chicago.
I'll say, yeah, I mean, asking, what's wrong with the competitive outcome, it's always a great place to start, but, very often then you can think of a very important reason, not little reasons, but, important reasons why you would expect competitive markets not to work very well. So we know, for example, that in providing health insurance, moral hazard and adverse selection are key, and so competitive markets are unlikely to work very well. And I would think in terms of financial variables, I would think we've lately come to appreciate there is such a thing as, macroprudential risk. So it's, just individual actors may not, they may lead to a social outcome which has more aggregate risk from purely financial sources than, the should as a society want. But do we know very well how to measure that or how to regulate it? That I think we probably still don't know very much. But it's certainly a good question.
Robert?
So more broadly, if I think about the role of government, there are clearly some very important basic functions of government in society in terms of things like defining and maintaining property rights, issues related to security, other basic functions. But of course, governments in general have gone well beyond that scope. And I think there is a view, you describe as a Chicago lunchroom view, I guess, that that's why typically when you think about should I be doing more or less government, you're kind of starting from a position where the view is that government's gone way too far in general, so that in most cases the argument would be it'd be better if it was doing less. You wouldn't take that view if you were starting from a situation with basically no government services. Then I think you would focus on these basic functions. Now there can be some important regulatory role, as was mentioned, things like capital requirements, there's good arguments for. If you think about the housing crisis in the US and its role in terms of the financial crisis, I think you can certainly argue that government played as much of a role as the private sector in terms of creating the crisis in the first place, particularly in terms of basically subsidizing and encouraging the vast expansion of housing investment and easy mortgage credit in the US. So it's not obvious in that sense that more government was helpful. Of course, it depends on what the government is doing in general.
Can I ask a follow-up question? So is there sort of a risk that macro models are too focused on efficiency, which is where a lot of you guys work lie, and perhaps less focused on reallocation? Nancy brought up health insurance, but I think if you think about sort of what keeps us up at night is a little bit sort of the Trump risk factor, which is created by inequality, which is something that we have generally not focused much on in macroeconomic models. So is it time to move beyond sort of Pareto efficiency and focus a little bit more on inequality, or?
Well, I think macro's moving in that direction. There are a lot of, now people are looking, and studying heterogeneous agents macro models. So macro models with, like different types of households, different, labor endowments, different, wealth, and starting to even look at some of the policy, what's the implications, how does monetary policy work if you have hand-to-mouth households and wealthy households who are savers. So I think, if you say we haven't done that in the past, I think part of it was just, there's the kind of technical frontier. If you're working with paper and pencil, you can do a certain amount of stuff, and heterogeneous agent models would not be one of it. And even if you have, like limited computer capacity, you're probably not going to be able to do it either. So, but now, a lot of those, the second constraint is getting, relaxed by the minute. So I think, the profession, the macro profession is certainly moving in that direction already.
Robert?
I think this issue is much more natural to think about in the context of long-term economic growth and what matters for that, as opposed to kind of short-run macro stabilization policy or financial policies. I mean, in the economic growth literature, particularly the empirical branch of that, I mean, this has been a central issue for a long time, particularly the relation between inequality and economic growth, but it's not obvious it has the kind of trade-off that I think you're envisioning, that somehow in order to get more growth, you have to give up in terms of having more inequality. The data don't seem to look like that. I'm always particularly heavily influenced by the observation about China, since it moved toward more of a market economy at the end of the 1970s. I mean, you're talking about moving several hundred million people out of poverty, and I think that's the biggest, probably all-time contribution to improving the welfare of poor people that's ever been accomplished. And it was basically done by looking more at efficiency, or in particular at promoting economic growth. And I think that's the typical relationship that you see, that in most cases, I think the best way to help poorer people is to do things to encourage the overall pie to become larger, which in this case means more economic growth over a long period.
Luigi?
I don't think that macro needs to be blamed for everything. I think that, honestly, a lot of other discipline economics have forgotten the redistributional aspect, starting with IO. And it's just most of the stuff on is the Harbinger triangle that we know is small, and we don't focus on the gigantic rectangle of redistribution. You know, Carlos Slim went from being the richest man on earth to being only number 4, with a loss of 31 billion in wealth. Now, don't cry for him because he still has 40 left, but still. Why? Because the mobile industry in Mexico was deregulated. And was, so that proves the fact that there was a redistribution before, driven by government regulation, that was taking from every consumer of mobile service industry in Mexico and giving to Carlos Slim. But this is not only of developing countries. If you compare the price of mobile phones in the United States with the one of Denmark or Germany, we estimated there is a $50 billion a year transfer from consumers to producers. And probably there will be more now that T-Mobile and Sprint are going to merge. So this is important government policy, and if you only look at some abstract notion of efficiency is one thing, but if you compare across countries and you see what they get in Denmark, and I'm sure you know how much cheaper it is to make phone calls in Denmark than it is in the United States, and I don't think the quality, because in the United States, because we have much better quality. In New York, I cannot get a phone to go through, so it's not that great. Anyway, I think that this is a more general problem. It's not just macro.
So I agree with Robert that it's in terms of growth, like growth typically leads initially to inequality, and so increases in inequality are not something to worry about there. But I will also say, I think in terms of thinking about cyclical fluctuations, probably the distribution of those, the consequences of severe downturns across different groups is important. I mean, you think about where does unemployment hit? It doesn't, hit uniformly across, the well-educated and badly educated, for example, to take just one. So it's the consequences hit disproportionately particular groups. So if we want to think about, policies to ameliorate the outcome, the downside of, a severe recession, we certainly have to think about. I would say it's useful to think about heterogeneous agents. That's all. And thinking about policies to mitigate those outcomes. Yeah.
Robert?
Luigi, I missed your last point about, for example, deregulating the market for cell phones, having a more competitive market. So, of course, I would think that would be a good idea, but I would think about that along with a host of other policies that really amount to promoting markets, promoting economic growth. So I don't see why there was any conflict there. And
actually, the world is more complex. Do you call number portability of your phone number portability deregulation or regulation? Because there's no rule written somewhere that should be portable. But if your number is not portable, there is less competition in the phone industry, prices are higher, and quality is not any better. So introducing number portability, you choose it whether you call it regulation, deregulation. I don't care about the label. The substance is there is more competition. But then you say, what about your bank account? In Europe today, it's easy to transfer a bank account to another because there is a thing called open banking. In the United States, there is not. Why? Because the banks are too powerful. And then we go to your social graph portability. Why Facebook has a monopoly power is because it's not easy to transfer your information from Facebook to another competitor. Now, we need to think about intervention to promote competition. I know that this sounds like a contradiction in terms to an old-fashioned free market guy, but if you want real competition, you need to have real rules, and real rules sometimes interfere with the initial allocation, but I am in favor of interfering when these real rules bring more competition and more efficiency.
No, but going back to Annette's point, I didn't think you were coming up with some kind of trade-off between efficiency and distribution. The kinds of policies you were talking
Annette
about.
is going to get the
Yeah.
last word, then it's time for
Let me
coffee.
make this more concrete. Suppose 1 year from now we'll be back here, we'll be on a panel of how do we end up in a recession because of protectionism, and everyone will say, oh, well, as I had already foreseen, this was because there was lots of inequality, Trump got elected, we wanted to benefit the steel workers in Indiana. Inequality is not just a sideshow. Like, inequality can actually drive policies, in that case, not very good policies. And somehow by ignoring it, we are ignoring, I guess, inequality risks should be something put into the macro models.
I think that's a good closing remark. So this is the end of the panel, and now it's 15 minutes of coffee. But first applause.